You can't take it with you when you're gone, so how do you make the most of it while you are here? It's time for Your Money Matters with Sam and Dieter from Harness Financial.
It's just Dieter this morning, though. You've got Sam is outside, but you've got a guest with you, Dieter. And I hate to say it, this is a pager-free zone, as you mentioned. But the notes I've got said use the word ticking time bomb. I'll let you take it away.
Yeah, we thought we'd bring in a bit of alliteration just to make a powerful point. So, today we're going to be talking about a tax time bomb on offshore UK pensions that haven't moved across. And it's something that we all need to be aware of and know that it is there. And as someone who's moved countries, you move country, you're trying to set up a new home, you're trying to get your life started, you kind of leave a lot of admin behind. So, and that's, the longer you leave it, the worse it gets. But this morning I've got a really, really good, knowledgeable person with me here and a really good guy as well, Hugh. So Hugh is from iSelect. And would you like to just tell us a bit about yourself and iSelect?
Thanks, Dieter. Thanks, Sean. So, yes, I'm Hugh Stevens. I'm from iSelect, a business that looks after the retirement savings of people who have shifted countries during their career or even people who have arrived in New Zealand for the first time after living in another country. So this process is quite often complex and quite costly, and so we're a specialist in helping people simplify their life savings and bring everything together in one place. And we work mostly with regulated financial advisors like Dieter and the team at Harness, and we also have some clients who come to us directly as well. But most of these clients are here in New Zealand. We also have quite a number in Australia as well, and we'll talk about that a little bit later. And then we have people dotted around the world as well who use New Zealand as their hub or the core of their financial life. And in total, we look after about 400 million of people's life savings.
400 million. There's a good number to have in the bank.
Hey, can I just ask, is there a particular location in New Zealand where we have more expats or people are moving around? I'm thinking Wellington, awful lot of people come here and work for Weta, expats and stuff and people from overseas. Is it spread evenly around the country or are there little pockets?
Yeah, very much so. There are pockets. I suppose you can think about Central Otago and Wanaka and Queenstown, one pocket. We can think about Canterbury, I suppose, as some of the agricultural industry there attracts people back home. We have Hawke's Bay, maybe for the weather. Wellington, not for the weather.
Yeah.
And of course Auckland. A number of people end up there, but yeah, very much in pockets.
Yeah, don't forget Bryan's Bay.
Okay, yes, of course. Yeah. Of course. Though you heard the word, I had a discussion. I'm not allowed to call you a Yapi, you're a Safa. Safa is the acceptable word now.
I have a very thick skin either way. I don't mind. So when we talk about people who've moved here from the UK and there's different opportunities and there's a certain period in which they can move it across and not pay any tax. So how does that allow them, or what is that term and the requirements to be able to not pay tax when you move it across?
So the idea really is that I suppose the tax rules are set so that people can shift countries during their life, and they shouldn't be disadvantaged in doing so. So the idea really is that as you shift country and shift tax domicile, then you should be allowed to shift your retirement savings as well. And so the New Zealand regime is that you have 4 years after you arrive in New Zealand to shift your superannuation savings. Now, there are rules around that, and we have to check each case to make sure that, I suppose all of the rules, the exemption applies. But you really get two chances at having that 4-year exemption. Firstly, if you've been out of the country for 10 years or more, or you've never lived in New Zealand, then there is a transitional resident arrangement whereby you don't have to pay tax on your worldwide income. It's only after 4 years in that case that you have to start paying tax on your worldwide income. And then if that exemption doesn't apply, then there's a second chance, which is really there's a general exemption for shifting superannuation savings within a 4-year period. So, that's the ticking time bomb, that basically everyone turning up in New Zealand to live here for a long period of time, it's not the first thing in mind, I suppose, when they're shifting is their retirement savings. So what we're saying to people is actually don't forget about this. Maybe it's not the first thing you think about, but it should be fairly top of list somewhere.
And just to reiterate, this is obviously a complicated scenario, and so personalised advice is required. So what we're doing now is general advice, but I'd highly recommend, if not us, speak to a professional. So the longer they leave it, there's a sliding scale, and it goes up to, 48% of the value of the pension?
Yes, well, it starts at zero, of course, at the end of the 4 years, and then in the fifth year it's around 4.5%, almost 5%, and then you have and then it's basically a straight line. And the idea, the way that it was set, was that the New Zealand wanted to tax effectively the returns on the money during the period it had been in New Zealand. So I think you get around 26 years before there's no tax benefit in bringing back. So you do have a long period of time, but one of the challenges at the moment is that, of course, you can't pay that tax at the moment out of the amount that's been transferred. And so the longer you leave it, the harder it is to find other money with which to pay the tax bill. Now, that's something that's been looked at the moment to see whether we can actually use the transfer amount to pay that tax bill, which opens up the possibility for a wider range of people. So again, there's another group that should probably be in touch.
And just to make it clear, when we're talking about the taxable portion, if you had a $500,000 pension and $500,000, when it moves across here, and let's say 40% of that is taxable, then 200,000 gets added on top of your income for that year and taxed at the highest tax bracket.
Well, it's income. It goes into your taxable income calculation. So yes, that looks quite scary in 1 year. But look, another reason to either get in early or to start the process.
Now, I've had some real world examples. I had a client back in 2020. We moved $500,000 across, and he left it too long. He had to pay $110,000 in tax.
I was going to say, do you know anyone who's lost a lot by just not getting onto it?
Well, that was my example, but I think you've got a couple of slightly bigger examples.
Well, I suppose the tax laws are complex, so people miss out for all sorts of different reasons. But a couple of weeks ago, we had one situation where a client looked to transfer from one of the state sector pensions in the UK, an NHS pension, and they were going to be allowed to transfer except for the fact that they just turned 65. And the specific rules of that scheme in the UK were that transfers were not allowed after the age of 65. So they missed out. And of course that means it's staying in the UK, that they will be paid that pension. It'll be taxable in New Zealand. And potentially subject to, if they if they die after the age of 75, then they might have to pay income tax on the amount transferred to their successor as well. So there are definitely real world examples of people being caught out.
Guys, it strikes me too, this is something where, time is actually of the essence, because the people who are involved here, when we talk about, guys, someone turns 65, you need to be across to this, but there are all sorts of problems in this. Like, you're New Zealand-based operators, right, and advisors and everything. These people are coming. How do you reach these people when they come to New Zealand? How do you give them the heads up that they need to get across this relatively quickly before they lose all sorts of opportunities and all sorts of money? It's hard.
Well, and look, I think maybe we haven't covered a key point here, which is, I suppose, the UK retirement savings regime is that people accumulate the money tax-free. So if you think about in New Zealand, we pay into our KiwiSaver out of our after-tax income.
Yeah. So
whereas in the UK at the moment, it's out of your before-tax income. So you're not paying tax on the money that goes in. Yeah. You're also, there's, I suppose, mostly no tax on the investment returns while it's in the retirement scheme, which is different to KiwiSaver, for example, where you get pie tax while you're in the scheme. And then, of course, in the UK, you get the income at the end tax-free. Now, it's the complete opposite in New Zealand, where we pay out of our after-tax income into the scheme. It gets taxed while it's in the scheme, and then the benefits at the end are tax-free. So, of course, it doesn't take long to figure out that if you shift from one regime to the other after you've accumulated your savings, then it's quite a good tax outcome in New Zealand, and that's the other benefit. So that's why people are moving as well.
I got a question in from Ash. What's your combined experience with shifting pensions from Canada to New Zealand, and can you recommend anyone to help with that in New Zealand?
Yeah, we have a number of clients who have transferred from countries other than the UK. I mean, probably the second most common is Ireland, because they have a very similar regime to the UK, and they also require the money to be put into a regulated scheme in New Zealand, which is what we are. We are licensed by the Financial Markets Authority, and we are subject to the same regulation as KiwiSaver and other, well, similar to KiwiSaver and other managed funds. Some countries, I suppose the transfer really involves selling down the assets in the country you're leaving, and I suppose transferring cash. And so there aren't the tax benefits, but there are the benefits in terms of simplicity, reducing, I suppose, the costs of investing, because you're going into a very standard scheme in New Zealand, and having the money closer to home and using a local financial advisor, I suppose, so that you feel more attached and in control of your financial future. So we definitely work. We've worked with people shifting from Canada, US, Singapore, Hong Kong, other places, and it sometimes has a tax benefit, but not always.
Yeah. The other thing which I thought about and concerns me is we obviously have a future risk. Now, the future risk is the government superannuation scheme won't always have enough money. So if you leave it in the UK, there's a potential for future offsets, because it's technically an offshore pension coming in.
Yeah.
So you might end up getting less of a government super than you could have. And also the tax regimes change, so you never quite know where you stand. So what I prefer to have is to have some sort of certainty and know where you are, rather than sort of leaving it at the hands of politicians and regimes to change laws, and you're affected whether you like it or not.
So that's a kind of risk reduction strategy, right, Dieter?
Very much so. Have things in your control rather than out of your control, as far as you can.
Yeah.
Look, the thing that strikes me thinking about this too, there are an awful lot of people who move around the world, and are mobile, people with skills and people with a bit of money, and probably not something I'll ever confront, because I'm a bit of a homebody. I can't see myself leaving New Zealand now. I'm stuck. But look, really interesting to think about and conceptualise, because we all do have different tax rules, different super rules in various countries. What is the best way to get a hold of you and figure all this out, Dieter?
Well, you can get our website, harnessfinancial.co.nz, or give me a call, 021 0268 7955. And here?
Yeah, well, we're at iselect.co.nz, so that's inconveniently i-select.co.nz. We'll have to deal with that, but thank you very much.
Yeah, and of course, you get hold of Dieter. Dieter, if you need your services, Dieter puts you in touch.
Totally,
right?
Yes. We work closely together.
Yeah, it is always fascinating, and we'll see you guys in another fortnight. Well, we thought it was all over for the Harness Financial boys, and I've called Dieter and you back in because we had a late inquiry. I want to do this from Paul, who's a regular correspondent. He said, hi guys, I am probably getting a small inheritance. Well, probably, does that mean you've put the arm on? Of around 50K. Do I, now this is a general question more, do I have to pay tax on this, and how much? Is there a way around not paying tax on it? That's a legal way, I think we're presuming. Yeah.
So I think the first thing we need to just make sure is, where is that inheritance coming from? Are we talking about a UK inheritance or?
Okay, Paul, you're listening, obviously. Can you text us? Why not just ring in, Paul, for goodness sake? And we'll give him a moment to ring in. Okay, well, let's run through the scenarios. If it's an overseas inheritance, what are the rules in inheriting money from overseas?
So from my experience, your estate is normally handled in the country that it's administrated. And then the distribution is a net of tax distribution. So your estates, like for instance South Africa, it has its own tax sort of number. It's got its own sort of set of rules.
Yep.
It gets cleared up, debts get paid, tax gets paid, and your beneficiaries then have an after-tax distribution.
All right.
That's my experience with it here.
And the Kiwi tax man doesn't clip the ticket on the way through?
Well, I suppose we have our double tax agreements, so then our tax departments have fought it out in the past as to who gets what, and what credits you can take advantage of in your tax return in New Zealand. But yeah, absolutely. I mean, the UK situation, there are some rules around the age that someone dies. So you may have different treatment if the person dies before or after the age of 75.
Yeah.
Absolutely, I agree with Dieter.
Okay, but strangely enough, this is from family in New Zealand, so it's more you, Dieter.
Yeah. Then your estate will be wrapped up, tax paid by the state. So essentially, your person that's passed away, it's their final tax return being sorted out.
So any money that go to the people they've designated to want the tax on the estate's being paid, the person who receives the money doesn't have to pay tax on it.
No, so it's effectively a capital payout. It's not an income.
Okay.
So
the final reckoning.
Yeah, and the interesting in the UK and what people don't realise is there's inheritance tax over there. So I think it's, what, 385,000?
And I know the left talk about it here.
Oh, yeah. That's...
You know, they are quite keen on the idea of removing intergenerational wealth.
Well, I think in the UK they're starting to talk about it too, and at the moment pensions are exempt from inheritance tax, but the current government that's just been elected in the UK is opening a conversation about maybe raising money through inheritance tax on UK pensions. So another reason to talk to Dieter.
Yeah, that's right. And it's like the jingle says, you can't take it when you're gone, but you can at least leave it to someone you like, couldn't you?
Well, I think the real key to avoid the whole inheritance tax issue or those sort of things is start structuring your estate properly while you're alive.
Yeah, absolutely.
If you get the right advice, get it structured correctly, you minimise the risk.
Yeah, and I'd say one other thing, which is, we didn't cover before, but I know people are listening to this around the world as well, and New Zealand is a good place to structure your retirement savings. I mean, we have good laws, good institutions. We're better than Bermuda, I suppose.
Mauritius, Bermuda,
exactly.
Panama.
So surprisingly, a number of people do use New Zealand as their home for their financial well-being. So we talk to people about that as well.
Yeah. Now, Paul's come back and he says, Bill, thanks. Dieter and Hugh, thank you for that wee bonus edition of Your Money Matters with the guys from Harness Financial.
Your Money Matters with Sam and Dieter from Harness Financial. To make the most out of your money, visit harnessfinancial.co.nz.